If you had to write a software that maximizes wealth from the perspective of a company, so imagine you write an algorithm that mimics a company and it maximizes for wealth, would you include the financial markets as part of the decision-making process, or would you just focus on the company? This is the Not Even Wrong podcast. It's February 10th, 2021. This is Krim Delco. For the day, the fund is down 4%. The market's down 10 basis points. For the year, we're up 21%. The market is up 4%. We're outperforming by 17%. Today, we're taking a hit primarily by Tesla. Basically, the whole the whole drawdown is Tesla. And there are three news items which are driving negativity around Tesla. I think number one is some bad news out of China in terms of quality issues and things like that. Some news also out of Germany about China mixed Model 3s, made in China Model 3s that use the new LFP battery. We spoke about this and we will discuss it a little bit more here also. There is some news also about delays in Berlin. And finally, we have the Bitcoin story, which I think overall is a negative, just simply because Tesla is selling Tesla shares to buy Bitcoin. Doesn't feel right. So these are sort of the news items that have accumulated in the last couple of days, and I think they warrant a correction of the stock. Maybe 10%. It has corrected now, roughly 6%. So we think there's probably another couple of percent downside here in the stock until it finds some base. These are the swings you have to deal with. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And this is how it feels like. Sometimes you wake up, you're down 4%. There's no real news, but you've kind of expected it. And now it's happening. And that's fine, actually. As long as things are working the way you think they should be working, I think it's fine, even if it doesn't work your way in terms of P&L. So we had some good news also on the PacBio side. There's an investment by SoftBank. I think PacBio is one of the disruptive companies in our portfolio. In a nutshell, we're looking at a lowering of the cost and increase in accuracy of long reads. So long reads over time, I think, will become the standard in genomic reading, genomic research, and we've discussed this also before. Think about the potential just in liquid biopsy that long reads can offer. We believe that that is definitely a very interesting situation. The company has said a few weeks ago at the JP Morgan conference that this year is going to be an expansion year. So this investment should help the company to expand, which is a good thing. Now let's get to our topic of today. If you wrote a software that maximizes for wealth, so let's say you have a virtual company and you write an algorithm that maximizes for wealth. We've spoken about this before also, in a sense that think about the following. How is a software going to be written? If a company was a software, how would you write it so it maximizes for wealth? And the question here is twofold. Number one, how would you do it? What would you do? And second, would you actually even incorporate the financial markets? In other words, do the financial markets matter? Following David Deutsch's argument, that is, if you can't program it, you don't understand it. So in a sense, if we want to understand how the financial markets actually price, or how wealth is generated in the economy, do we need the financial markets for that or no? So let's first attack the first question. How would we even write a software? And I think we would do things that we've discussed in previous episodes many times along the lines of our principal stack. So we would have 0 to 1, we would have innovation stack, the innovator's dilemma, and David Deutsch's The Beginning of Infinity incorporated in the algorithm. Of course, I don't want to go into details now how you actually would code this, but you would have those principles reflected. You would have a unique monopoly building company that is building an innovation stack that is attacking a market either that is not being served or that is being underserved right now. And you would absolutely build an innovation stack through accumulating explanatory knowledge and creativity. Those are the sort of things you would do. You would have a lot of the ingredients that we learned from the Reed Hastings, no rules, rules. So you would build a Popperian epistemology within the company where criticism is part of the culture, where you continuously drive for better decisions. You would have very high talent density. So the algorithm would have to be able to identify talent, and talent, according to Reed Hastings, is a temporary thing. There is a time when you are the best person for this job, and there is a time when this job is the best possible job for you. So these things change, and you have to find a way to morph the company towards the best talent for the actual necessities in the moment. But more importantly, from our perspective, is would you even care about the financial markets? This is a fundamental question that Wall Street, I'm sure, is very uncomfortable even thinking about, because it actually questions even the necessity of Wall Street. Now, let me be clear, Wall Street is a plumbing mechanism. So Wall Street is sort of necessary just because that's where we transact. That's where we actually transact. It's a little bit like the conversation we had about money. I mean, money itself, of course, fulfills no other purpose than transaction purpose. But we need money in order to get rich, because money is the measure. So in a sense, that's how we think about Wall Street. We need Wall Street because that's how we met. Wall Street is a scoreboard. But does the scoreboard itself have an impact on wealth creation? The answer is no. This is a conjecture. I don't have a proof. Maybe this is worth an academic paper. I would say that Wall Street does not have any impact whatsoever on the wealth generation of a company, because Wall Street is the scoreboard. Wall Street is literally the scoreboard, and the scoreboard, like in a football game, the scoreboard cannot impact the players. Now you're gonna start, yeah, but psychologically, if you're down 3 points or whatever, yeah, I get it. I mean, there's certainly some recourse, some reflection there. If the scoreboard is very much against you, you might lose motivation. But I say over time, over many iterations of the game, the scoreboard certainly has no impact. And this is how we think about Wall Street. So if you wrote an algorithm for maximizing wealth, you would pretty much do, let's say, what Jeff Bezos has done at Amazon, what Bill Gates has done at Microsoft, and what Elon Musk is doing at Tesla. In fact, the one thing that I don't like about Elon Musk at Tesla is that he's paying way too much attention to the financial markets, in particular to the shorts. So he's making a mistake there that they have an influence on him. And I think they do have an emotional influence, certainly, on him. They have an emotional influence even on us. I mean, if people attack a company that you're long, that you like their product, there is an emotional influence. But fundamentally, if you really want to maximize wealth as a company, as a CEO, as a founder, you should not pay attention to the financial market whatsoever. Some of the numbers underline that. For example, the company's growth, though the stock growth of Amazon reflects almost exactly the compound growth of sales of Amazon. So clearly there's no relationship between the financial markets and the valuation of the company. It's all driven by what actually Amazon did. And there's other examples like that. I think if you did a long-term analysis of wealth generating companies, no matter where they are, no matter in what context, most of them are Silicon Valley companies, so that's fine, but it could be Coca-Cola or something like that. So what I'm trying to say here is that it is definitely not just, oh, because it's Amazon, or because it's Shopify, Netflix. This applies to anybody, everywhere, all the time. If you have real growth, you are going to grow your sales and your market cap according to the compound growth rate of your sales. If you have inflationary growth that is, for example, just driven by higher prices and pass-through prices and things like that, then the market is different. The market doesn't pay anything for inflationary growth. These are facts. If you want to do a regression analysis and numeric analysis of the market, you will find that. So inflationary growth is pass-through growth that just simply passes through price increases in the value chain. That is not the kind of growth we're talking about here. We're talking about real growth. Or if you use the analogy of, imagine we had a fixed money supply. So let's say Bitcoin is the currency on earth. and money cannot grow anymore. So the only way you can generate wealth is by getting a bigger piece of the pie. And there is also nobody like the Fed that can actually sort of channel more of that pie towards you. So the only way you can get a bigger piece of the pie is through competition, is through actually doing better than somebody else. Relative value creation. This is the pure Chicago Austrian School of Economics type of thinking. In that context, the only way you can generate wealth is really by having something to offer to the marketplace that others don't, and that, of course, people demand, and therefore you have a relative increase in your wealth towards others because you get more of the pie. And there is no influence whatsoever that market players have. What I mean with that is that hedge funds, value investors, BlackRock, you name it, whoever, even us, we are participants in the growth of the company. So we're attached to the company the same way customers, employees, investors, we're just what people call stakeholders. And this is just another way to think about stakeholders. We are stakeholders. We're not something special. Investors are not something special. Investors don't express creativity as it relates to the company. It is the employees in the company that express that creativity in order to grow the company. The investors are like customers or suppliers. They are attached to the company and they grow with the company. And of course, they can generate wealth the same way a supplier can grow actually at the same compound rate like the company, because their compound rate will grow with sales. So we are suppliers, and we're suppliers of capital, of course. That's why we are actually just part of the value chain, the same way that a supplier of steel or electricity or whatever else is necessary for production, labor, the employees. So in that sense, it's a very Marxian way, actually, a way of looking at things. So we have labor, we have land, we have capital, the very orthodox economic view of the world. And in that sense, we're just going to grow with the company. So the company actually decides, the founder and the management team and the employees, they decide how much they're going to grow. They express the creativity, the explanatory knowledge that is necessary to generate relative value and grow their wealth in relative to the rest of the economy. And we investors are not influencing that. Now, you might say, well, that doesn't make any sense. Isn't there like valuation models? Isn't there PE ratios? Isn't the market deciding those things? And the answer is no, it's not. That's why these models really are actually useless. Using PE models and things like that for short-term trading and things like that. Yes, of course you can use it. That's what algo traders do. I'm talking long-term wealth creation here. Irrelevant. Does it really matter if Amazon trades at 3 times sales or 4 times sales today? Who cares? It's completely irrelevant. What matters is the actual inner workings in the company. Like, for example, our principal stack hopefully is a good way to think about a company and analyze a company and see, okay, does this company have the potential to generate compound growth? Has nothing to do with the valuation. Irrelevant. Now, of course, you have to kind of say, well, but the scoreboard can be wrong. Here's another caveat. What if the scoreboard is wrong? Don't we have booms and busts in the markets? So, yeah, that's true. We can have a wrong scoreboard. So things like 2008 can happen, a financial crisis. Amazon was down 80% or something in a short period of time. Yeah, these things can happen. So that's why you need to manage your leverage so you survive. Okay? It is paramount for any investor in any situation to always stay alive, financially, of course, because you will then get through these short-term disruptions in the market. That these disruptions happen, and that's fine. There's nothing wrong with that. We can't expect the scoreboard, which is the wisdom of the crowd, the financial markets, to always be correct. Of course, that would be crazy. And if we actually knew how to design a market that is always correct, then yeah, we wouldn't have what we call Wall Street and financial markets right now. And we would have something else, and it would be maybe more interesting and less nerve-wracking, but we don't. So what we have right now is sort of a jittery, sometimes very depressed and sometimes very euphoric market. And these things need to be incorporated into the management of the money. But again, it's not in terms of, okay, which PE ratio do I use or anything like that. That's why I said the actual degrees of freedom that we have, and we've discussed this many times before, the actual degrees of freedom we have is only one. Which company do I invest in? If I pick the right one, that's it. I don't even have, I should never sell. And if I'm wrong, then of course I need to get out. But then I've just made a mistake. My degree of freedom is to pick the right company. That's it. And if I'm wrong, of course I have the ability to get out, which is a good thing. But the point here is that I don't have other degrees of freedom. For example, timing, using options versus equity, that's all a waste of time. Makes no difference whatsoever. So conclusion of this episode is that if I wrote a software that maximizes wealth, I would design a company according to our principal stack and not have the financial markets incorporated. We investors have no influence whatsoever on the wealth generation of a company. We are suppliers of capital, and we are exactly like the suppliers of labor or suppliers of other goods and services. We are going to grow with the company, and the company decides what the growth is going to be in terms of compound growth of sales, and that is the compound growth of wealth that this company will generate. Thank you.